Aloha. I'm Stan Cox, Principal Broker and Strategist with SC.FSIC. And in this video, we're going to talk about the cash value and death benefit and how of whole life insurance and how they go together. Because I get this question a lot. And I was just reminded of that fact today by a new client. So I thought I'd go ahead and address the question here in this video. And that is, the question is cash value in addition to the death benefit on the payout? So with participating whole life insurance, which is only issued by mutual companies, the profits generated by the company are shared with the participating policy holders by means of dividends. With all but final expense whole life policies, cash value accumulates within the policy by means of a designed overpayment of the cost of insurance, and then a guaranteed annual interest payment. And that holds true whether the provider is a stock company or a mutual company. But mutual companies pay not only a guaranteed minimum interest APR, but they also pay a dividend in addition based on the profitability of the company. So the dividend portion may fluctuate, but the minimum APR is guaranteed. And usually the dividend interest earned by the policy is assigned to purchase additional paid up whole life insurance. And it also goes into the cash value. Those two things are intertwined. That is, one may be accessed separately, the cash value, or they may be accessed together as the death benefit or face value. In a policy illustration, you will see everything broken down into components. There will be the cash value of additions, total cash value, end of year, and total death benefit, among other components listed. So I'm going to go ahead and show you a portion of a cash value illustration here. Let me get that going for you. And here it is. Notice that the cash value increases each year, as does the cash value of additions and the death benefit. The premium never increases, but the total amount of insurance does, and the cash value grows. And you can see that here. This is the face value or death benefit, the amount of the insurance here. And this is it's the cash value accumulation of the policy. It's called surrender value for the sake of insurance illustrations. The cash value is the part that we access by leveraging the account with policy loans for the practice of our precious infinite banking strategy and tax-free cash growth warehouse. Very often when showing and discussing these items, my client will ask, so when I die, will my beneficiary get the death benefit plus the cash value? Well, the answer is actually yes, but you need to understand how that works. And again, look at the growth of the death benefit here. I'm going to make it a little bit bigger so you can see it easier. There we go. So the answer, well, let's take a look at this policy. This policy was originally designed with a death benefit of $1 million, okay? Each horizontal line here represents 1 year of the policy. The top line shows a total death benefit of $1,015,007 right there. The $15,007 in addition to the $1 million reflects the additional paid up insurance benefit purchased by the dividends paid to this policy. You can see that the annual dividends paid here is the same as the cash value of additions. So this is the annual dividend. This is the cash value of additions, same amount. Just a little less than the actual cash value or surrender value end of the year. But the increase to the death benefit is $15,007. So the return on investment there, as far as the dividends, what it buys is more than 300%. That is $3,800 of dividend buys $15,000 of death benefit in this case. And the total cash value, called surrender value here, is just over $4,000. So is the cash value paid in addition to the death benefit? Remember, the policy was designed to pay a death benefit. This policy was designed to pay a death benefit of $1 million. And already that benefit is increased by $15,000, 400%, almost 400% of the cash value that is accumulated in the first year. So you can see that the death benefit of the policy grows every year, as does the cash value. At about the 8th year, the cash value growth begins to outpace the growth of the death benefit. And that is because the policy is guaranteed to have a cash value equal to the death benefit by the time the owner or insured reaches age 100. That is the maturity date of the policy. And at that time, the full face value that policy has grown to will be distributed to the still living insured or owner of the policy. This particular policy, issued for a 50-year-old man, will grow from $1 million face value to about $3 million in face value in the 50 years that it goes to maturity. Here's a graph. I'm going to show you this graph here. I get that up here. Here's a graph that shows an intersection of the growth of the insurance benefit and the face value or cash value here. Okay. The value growth over time from inception of the policy through the maturation of the policy at age 100 is being demonstrated here in this graph. The face value is growing by the additional insurance that is purchased by the dividends paid to the policy. The cash value is growing by the guaranteed interest plus dividends that is paid to the cash value of the policy. That dividend interest is compounding, where the paid up additions are separate little chunks of whole life insurance. The cash value is actually available to the owner of the policy at any time. So you could actually withdraw or surrender the cash value, and the policy would continue as long as the premiums continue to be paid. But the face value would be reduced by the amount of cash value withdrawn. If you were to leverage the cash value with a policy loan, which is the recommended and preferred way to access the cash value, and the loan was never repaid, then the insured dies, then the face value would be reduced by the amount of the unpaid loan, the same as if the money had been withdrawn. So you see that the cash value is an integral part of the face value or death benefit. So typically, if the owner and insured are the same person and they were to pay the premiums until they reach age 100, they will have paid into the policy about 30% of what the face value has grown to. So let's say the original face value is 1 million, as illustrated in this particular illustration. And let's say the premiums are paid for 50 years. If the premiums total $26,000 a year, in 50 years, $1.3 million will have been paid in total premiums. The face value will have grown to about $3.4 million. Not a bad return. Remember, the policy started with just a $1 million face value. At age 100, for this example, the face value has grown to $3,400,000. So, is the cash value included in the face value? Absolutely, it is. I welcome your questions and comments. Please post them here, and please subscribe to this channel. And if you haven't, do yourself a favor, watch our free webinar, How to Become Master of Your Financial World. Just click on the link below the description, in the description box here, and watch the video. It's free. And if you'd like our help in establishing your own personal tax-free cash growth warehouse, we can help. Give us a call, send us an email. We're here to help. Mahalo for watching, and aloha.